Economics and politics usually go hand in hand in a US presidential election year. 2024 will be no exception, if not more so than usual. The performance of the US economy could decide the outcome of the November election. But election politicking could also have a huge influence on the performance of the economy before the voting day. Will the economy improve if Biden gets reelected? Or will the economy get worse if Trump wins a second term? If a soft landing is good for Biden and a hard landing is good for Trump, what about a no landing? Why is the US election both the biggest upside risk and the biggest downside risk for the US and the global economy in 2024? Economic optimism is in the air. The JP Morgan Composite Global Purchasing Managers Index picked up again in January for the third straight month. It now stands at a 6-month high. The slump in global manufacturing since the middle of 2022 appears to have also ended. Global manufacturing PMI is back at 50, its neutral territory. Global semiconductor sales, usually a reliable leading indicator for the world economy, is growing again after a long dry spell. If Wall Street has good reasons to be feeling better about the world economy in 2024, it is feeling even better about the US economy. This is evidenced by the fact that the dollar is rallying while the US stock market is outpacing the rest of the world. Wall Street economists again revised up their forecast of US GDP growth for 2024 last month. The consensus forecast for 2024 is now at 1.5%, nearly a full percentage point higher than only 6 months ago. And the upper revision is set to continue this month, given the blockbuster labor market data in January. Optimism is contagious and self-perpetuating. But when is too much optimism no longer a good thing? Wall Street economists don't like to be wrong, and when they are, they have a tendency to overcompensate. I was not in the recession camp, but even I did not expect the strong acceleration of the US economy in the second half of 2023. The 5% GDP growth in the third quarter was a huge surprise. In some respect, the 3.3% growth in the fourth quarter was an even bigger surprise because it meant the acceleration was no fluke. Both Wall Street and the Federal Reserve were taken aback by the economy's strong finish in 2023. After the most aggressive interest rate hikes in decades, the economy should be at least slowing down. Larry Summers suggested last week that post-COVID structural changes are raising the so-called neutral policy rate. Everything looks obvious in retrospect. What is clear to me is that even to pretend to have an informed view about the US economy in 2024, we need to first understand what really happened in the second half of 2023. A major driver of US economic growth in 2023 was government spending. By government spending, I don't mean big transfers to households like we saw in 2020 and 2021. I mean actual government consumption and investment at both the federal and local levels. As you can see on this chart, US government consumption expenditures and investment accelerated sharply last year. It grew 4.5% in the second half of the year, the fastest since the pandemic. A big part of the spending was a massive hiring spree by the US government. Over the past 12 months, the government has added on average 50,000 new workers every month, the fastest in more than 20 years. As a result, US budget deficit and financing requirement ballooned. Treasury issuance reached $2.3 trillion in 2023. For the full year, government consumption and investment contributed 0.7 percentage points to GDP growth, nearly half of that of household consumption that is 4 times bigger in size. Of course, 0.7 percentage point is only its direct contribution. Given the likely multiplier effect, the total contribution of government consumption and investment could easily be more than 1 percentage point, meaning close to a third of GDP growth. Neither Biden nor Powell will ever mention it, but fiscal easing played a very big part behind the so-called resilience of the US economy in 2023. I find it somewhat disingenuous that so many Fed officials continue to feign surprise at the apparent insensitivity of the US economy to high interest rates. This is because they ought to know better. Everyone knows that monetary policy works its magic through financial conditions. More specifically, an increase in interest rates has a dampening effect on the economy through a tightening of financial conditions. US financial conditions have been easing since the collapse of Silicon Valley Bank last March, even though the Federal Reserve went on to hike 2 more times. Indeed, financial conditions have eased so much over the past 6 months that they are now as loose as they were at the start of 2022 before the Federal Reserve embarked on its hiking cycle. Given the above, I don't think there's anything mysterious about the insensitivity of the economy to the high Fed funds rate. If there's any mystery at all, it is why financial conditions are not tighter, or why the Fed is not more concerned that it is so loose. For whatever it's worth, the easing of financial conditions over the past 3 quarters is the most substantial easing episodes that we've seen outside a recession or a major financial crisis in 20 years. A major part of this easing came from the massive rally in the US stock market over the past year. This has boosted consumer confidence, which in turn has boosted household spending by reducing personal saving rate. The reacceleration of the US economy over the past 2 quarters may mean that financial conditions are not only loose, but too loose. What this means is that a further rally of the stock market might carry the seeds of its own demise. So the resilience of the US economy may not be more remarkable than the result of a combination of easing fiscal policy and easing financial conditions. But what about the fact that borrowing costs have gone up for hundreds of thousands of businesses? After all, surely not every company managed to lock in low long-term interest rates during the pandemic. What about the fact that many of these companies continue to face high nominal wage growth and rising real wage growth? How can we square the resilient economy with the headwinds that many companies must be feeling right now? If the US corporate sector did better than expected in 2023, it had a lot to do with a big jump in labor productivity growth that recovered strongly in the second half of 2023. It is difficult to determine what was exactly behind the improvement in labor productivity, but this helped stave off a bigger drop in corporate profit growth. Indeed, the increase in labor productivity helped companies absorb higher labor costs without having to resort to big layoffs. While hiring slowed in 2023, the private sector still created more than 2 million jobs for the year. I suspect a big part of the improvement in labor productivity came from more companies asking their employees to return to the office even just for 2 to 3 days a week. Whether labor productivity growth can remain in 2024 at the 2% rate like we saw in the second half of 2023 will have huge implications for the outlook for both the economy and the stock market in particular. Other than fiscal easing of financial conditions, and a productivity boost from at least partial return to the office, there was another important positive tailwind that contributed to the average 4.1% GDP growth in the second half of 2024, a sharp decline in energy price. Average national gasoline price dropped a whopping 20% in the final 3 months of last year. This boosted the real purchasing power of households and helped ease inflationary pressure. This was the single most important factor behind the sharp drop of quarterly growth rate of the GDP deflator from 3.3% to just 1.5%. As I've already explained in previous videos, the sharp decline in oil price is largely the result of two developments. One, a sharp increase in US oil production from August onward. Two, an equally sharp increase in Iranian oil exports as the Biden administration stopped enforcing the existing oil sanctions on Iran. I remain of the view that getting macro right in 2024 means getting oil right. And getting oil right means getting Iran right. In my view, the strong finish of the US economy in 2023 was due to a confluence of factors that will be difficult to replicate in 2024. One, with the current gridlock in Washington, there is zero scope for fiscal easing. There's a chance that a child tax credit bill already passed by the House will get through the Senate and become law. But that is not a given. In any case, $79 billion could move the needle for the overall economy, but not by very much. Two, with financial conditions very loose and the labor market very tight, the risk is that inflation might get stuck before it returns to 2%. Three, increased geopolitical risks are already unleashing new negative supply shocks. Freight rates have soared as the result of continued Houthi attacks in the Red Sea. Front-month crude oil contracts have traded back above $70 a barrel, from a low of $68 a barrel back in December. All these developments will make it more difficult for the Fed to cut interest rates. Four, the US stock market has never been more expensive since the dot-com bubble. If Treasury yields back up because the Fed is held back by stickier than expected inflation, the equity market could be in for a wild ride. Five, of course, there's also the election to consider. Markets don't like uncertainties, and there will be a lot of uncertainties that will make the 2020 election look like a walk in the park. How will corporations respond to these uncertainties? The latest Business Roundtable survey tells us that CapEx spending will likely decline this year. This could potentially affect hiring too. This means the closer we get to the election, let's just say from May onward, the animal spirit could be very well replaced by risk aversion. I don't know how long the current feel-good, nothing can go wrong mentality in the market will last. I will be very surprised if we don't get a meaningful equity correction before the end of the first quarter. But I do think the economy will do worse in the second half of the year compared to the first half. All else being equal, that should give Trump an edge on November 5th. Thank you for listening. If you got something out of this program, please hit like and subscribe to my free YouTube channel. Let me know what you think by posting your comments on the video. If you want to learn more about my investment strategy, come visit us at davidwunbound.com.